Hello everyone. Today we're going to talk about 4x4 wealth multiplier themes in equity for 2022 to 2025. We have with us Mr. Madanagopal Ramu, fund manager and head for portfolio management services and alternative investment funds at Sundaram Alternates. Madan has close to 15 years of experience in the Indian financial markets. He currently manages assets of over 3,500 crores and has 5 years of experience managing funds. PMS funds, CSOP and SELF have been ranked in the top quartile across various timeframes. Thank you for joining us, Madan.
Thanks, Shweta.
So we'll get right to the themes. As we transition to a post-COVID-19 world and with Nifty at 17K, what are the risks to the market and how is the Indian economy positioned?
Oh, a good question to start with in these volatile markets. I'll just give 4 or 5 points on this, on why we think the India story looks very different from other emerging markets and therefore might remain to be an interesting opportunity for FIIs as well as the domestic investors. The first point is, if you look at India is probably the only economy which will be growing faster than what it was growing in a pre-COVID period. That is coming out very clearly. In the pre-COVID period, if you remember, we were struggling to grow both on the IT sector. IT sector companies used to have a single-digit growth that was impacting even services sector as such, as well as we were growing in not even growing in the manufacturing space. So manufacturing sectors used to report flattish sort of growth numbers. Auto sector used to decline a lot in the pre-COVID period. But now in the post-COVID world, due to various reasons, contribution coming from both, say, geopolitical issues, supply chain constraints, as well as the India's demographic situation, we are clearly seeing that India's growth numbers are much better compared to what it was in the pre-COVID period. To put it in numbers, pre-COVID, we used to work with numbers like 4.5%. Today, we are talking about 6%. And the IMF's expectation for the next year is for India 7% growth. Last week, IMF came with their growth numbers compared to their 3 months back numbers. Only for India and one more country, they have increased the GDP growth forecast for 2023. For every other country, they have reduced the GDP growth forecast. So that's a very important point to note, that while every other country is struggling due to macro issues, either due to inflation, consumption not being great, government struggling to support fiscal funding, India's macro numbers are looking very different and much better than where it was in a pre-COVID period. If you look at the India's forex reserves are at multi-year high, and India can handle the interest rate increase that can happen globally now with Fed starting in March. We can handle the impact of it on the currency much better than what we were able to do in the past. India's FDI inflows are very strong, as well as IT sector is doing really well. So these two sectors are adding a lot more job on the urban side. Now that is going to create urban consumption growth than what we saw in the last, say, 3-4 years, in my opinion. We were actually struggling on the discretionary spending for the last 2 years due to COVID impact. And now discretionary spending can really come back and really be growing faster, because job creation has been at a very high level compared to where it was, say 2-3 years back. On top of it, we have reasonably stable inflation expectations. Inflation actually can come down in the second half of this year as growth continues for India. So given this context, in my opinion, yes, there will be volatility in the Indian market. We might see Nifty being very volatile for the next, say, 1 or 2 quarters as the Fed starts increasing its rate, and subsequently every other central bank starts increasing their rate also, even including India. But I think at a 16,000 level or something, rather than me guiding on where the market will go eventually to, which is a very difficult thing to predict given various players in the market, what we can say safely is below 16,000, in my opinion, I think we can start seeing value getting generated in the market. And therefore, next 2 quarters, as the market remains volatile and we see opportunities, we see this as an opportunity and start investing into growth companies, high growth companies with a 4 to 5 year view, and create a nice strategy for investors who can come and stay invested for say a 4 to 5 year time period and really see a value getting generated for them. So we see the current volatility that will come through in the next say 2 quarters, even at these levels. One should start looking at opportunities to invest and stay invested over the next say 4 to 5 year time period. So that's the point that I wanted to make.
Our next question, Madan. What themes do you think fit into the new growth opportunities in India with the potential to generate alpha over the next 5 years?
Yeah, as we look into the current market opportunities, given the context I set it on the India macro story, we see clearly 4 themes coming out where we see investable opportunities for investors. As I speak about it, let me show a small presentation or slides. As I speak about it, you'll be able to. What we see is clearly there are certain themes emerging out of it, which kind of gives us a very clear guiding sort of post for us to select a set of companies where we can invest into, and we see clearly value getting generated in these four themes as we look at next 4 or 5 years sort of an opportunity in India. Let me take you through on a brief about each of them before we really get into a detailed about each of the themes that we are referring to. The first theme that we are referring to is Capex Maestros. We call them as Capex Maestros. Really, these are masters of how you can do, say, capital investment and identify really good opportunities in the sectors that they operate in, reinvest the cash that they generate in their existing business very efficiently for highly profitable projects, and sort of grow the earnings for many years to come. So there aren't many such companies actually who are capable of doing it, in my opinion. There are not many good efficient capital allocators to say, really. So these are very few managements or promoters whom you can talk about. Generally, there is the question that comes from many investors in a period when many people talk about investing into asset-light businesses. We are referring to here Capex companies, but we are here referring to companies who have very high ROCE in their existing business and able to identify opportunities at a highly profitable level and reinvest this cash back into the business, and therefore set a very clear earnings growth trajectory over the next 4 or 5 year time period. We are referring to such kind of companies. We are not referring to cyclical companies who tend to invest more when they make more money and stay with a very high amount of capacity, which gets utilized over the next 4 or 5 years. No, we are not referring to those kind of companies. Those companies struggle on a lower ROCE level. We are here referring to high growth companies capable of identifying good growth opportunities with very good ROCE on each of these opportunities, and execute these projects very well so that earnings momentum continues over a longer period of time. So that is the first set of companies that we are referring to. The second set of companies we are referring to is a very interesting opportunity that is emerging in the Indian context. I don't know whether other countries are seeing this. See, in India, the good private sector companies in each of the sectors, it can be a consumer company, it can be a banking company. These companies already have a very strong moat. These are traditionally very strong players with offline presence. They have a very strong moat. It can be due to cost leadership, or it can be due to a very good brand enabling them to charge higher margins. Today, what we see is these companies are spending a good amount of their money because they are highly profitable compared to their peers. They are able to spend more on digital. And globally, every company is getting into a digital mode, right? An omni-channel presence. So that is what we are referring to. These companies who have a very strong moat as an offline player, as a traditional player, today they are spending a lot more money than what their competitors can do, because their competitors are having lower margins due to poor business model. these companies are able to invest a good amount of money into the digital side and creating further capabilities. See, these capabilities can enable these companies to reduce their cost and therefore gain more market share out of it. Or they can actually create new avenues for customer acquisition and therefore can improve their productivity on the existing operations. And that also can contribute to a higher margin or a higher ROC in the business. So these are the kind of companies which, given the current valuation difference that is existing between the digital companies who are getting listed at what, somewhere like 10 times, 20 times of their revenue, we see valuations are reasonable for the traditional companies who are embarking into this digital journey. These are the kind of companies where we see if we can invest and stay invested for the next 4 or 5 years, they will grow superior compared to the traditional offline competition that is given, because offline competition is not able to catch up with them. On top of it, we are also seeing that these companies are gaining, not letting their market share go away to the digital players. This is the second set of companies that we are referring to. The third, which is very close to my heart, is the consumer spending. We have been very positive on this space for a very long period of time. Last 2 years, it's not been a great story because of the lockdown restrictions and all. But we think discretionary consumption, as I highlighted to you, will make a really strong comeback. We are particularly interested in companies who have a very clear growth trajectory, either by store addition or by expansion of geographical presence. And particularly companies who have a very strong bargaining power in terms of pricing capability. So we are going through a very high inflation scenario. The inflation will come down, in our opinion, in the second half of 2022. So companies with very good pricing power will be able to retain a lot of price increase that they have taken now, along with the growth. So with urban consumption coming back, ability of the pricing power to sustain for certain companies, if you can handpick those companies and stay invested, you will make a lot of money over the next, say, 4 or 5 year time period. So we are very, very excited about the consumption, particularly the discretionary consumption story playing out in the next, say, 4 or 5 years in India, with the kind of job creation that is happening in the market, which we have not seen for the last, say, 10 years, in my opinion. We are talking about so much of attrition in IT sector, so much of attrition happening in e-commerce space also. And now other services companies are getting into it, and they are also seeing higher job creation. So we are in a very good stage when it comes to spending, and affordability has also improved. So because of lower EMIs, lower interest rates, longer tenor loans for consumers, and income level increasing, as we have highlighted here, 18% growth compared to pre-COVID level. So all these are enabling very clear enablers for a multi-year growth to happen in the consumption space. I'm referring to discretionary consumption. The fourth one, which is a new emerging opportunity post-COVID, looks like there were here and there certain opportunities, but post-COVID world has increased the universe for consumer companies or say companies in the manufacturing space or in IT companies who are capable of exporting from here. So it can be consumer durable companies, it can be IT services companies, it can be manufacturing companies. We are seeing that either due to global value chain disruption or due to global digital spending increasing, therefore Indian IT services are able to grow faster. We are seeing certain real clear next 2-3 year time frame beneficiaries of this emerging new opportunities post-COVID world. And therefore, I think this again is a very interesting opportunity. It's not a very broad-based opportunity. We need to be very clear and careful about whom we play here. But yes, the universe is expanding clearly in a post-COVID world for us to search for ideas here. We clearly see the growth numbers here in IT companies, chemical and pharma drugs companies, and electronics companies, much better than what they were doing in a pre-COVID world in India. So that again is an interesting opportunity to kind of invest into. So these are the 4 broad themes that we find value generating themes that investors should keep an eye as we enter into next 2-3 quarters.
So the next question, Madan,
Yeah.
Tell us, as a general preference for asset-light businesses, why do you like capex-oriented companies? How are you able to find value opportunities here?
Yeah, that's a very important and good question, and I touched upon it in the initial remarks also. As against a preference by many fund managers towards asset-light businesses, why do we really see here opportunities in the capex-oriented companies? So, two distinctions I wanted to make. First point is I'm not here referring to companies who are asset-intensive, low ROCE, cyclical businesses like metals or energy. These we have seen in the last 10 years struggling to generate a reasonable return on the capital employed in their businesses. And they were very cyclical sort of businesses, right? So we are not referring to those kind of companies. We are here referring to, say, a consumer facing company or a manufacturing company or even a bank who are able to generate good return on their existing business. So literally each of these capex companies we are referring to are companies where we don't say dilute our quality parameters. What are the quality parameters? We don't want any company which is generating lesser than 20% sort of an ROIC on the existing business, and who are generating good cash flows out of the existing business. So the moment you generate a good cash flow out of their existing business and at a very high ROIC, if they reinvest this money back into a similar ROIC projects or expansion plans, then the growth for the company is given, right? So that is the beauty of this model. So companies and managements who are capable of doing this are very few, and in the overall universe that we are seeing. So it is important that investors get into these companies. See, India is a great growth story, as I highlighted to you, much better than many other countries. So you need to really bank upon managements or promoters who are able to identify opportunities. It can be in consumer facing companies, it can be in manufacturing companies facing export as an opportunity, but we need those managements who can talk about growth, who can talk about investing into projects, and therefore say getting the earnings growth for the next 4 or 5 years. And that really reduces our headache and finding out opportunities for every year or something. So if you can identify such companies, invest into them and stay invested for 4 or 5 years, as their capex plans get executed, earnings growth will be so impressive that the company stock price also will start reflecting the growth in the underlying business. Let me give you some examples and take you through on it. See where this kind of growth can come, where the companies can grow. It can be companies who are growing, say, they are taking their existing product or service into newer geographies, or it can be companies who have exhibited very strong leadership in an existing product and kind of growing in adjacent products, related products. Or it can be companies who have exhibited very strong capability to do a particular business and kind of identifying opportunities elsewhere and can replicate the same success there. So let me give some examples here. If you look at Navin Fluorine is a fluorine expert, and they were doing their business in the inorganic fluorides as well as in the refrigerant business. Now they are getting into, and they have used their R&D to identify new application possibilities for their knowledge in the fluorine space. So they refer it to as process engineering capabilities. They have now got into newer areas like fluoropolymers. They have gone into applications in EV. They have gone into applications into new blends that will come in the refrigerant space. So they recently have worked with go up substantially. And really from that context, their valuation are looking very attractive even at these levels, even after 2-3 years of very good performance from Navin Fluorine. And most important point, the company is not taking huge debt to fund this capex plan. They have very good cash generation and they are reinvesting that into their business. So you see their cash flows, which is very stable. Due to COVID, there was some changes here, but otherwise it's a very stable sort of a cash generating company and reinvesting that back into the business. They will get into a 300-400 crore of cash generation and they will reinvest that money back into the business. So they are investing but they're investing using their internal cash flows, but not leveraging the business. Excessive leverage can create issues when the cycles turn the other way. So we are very conscious about that these companies do the capex, but they do it through internal accruals and not take too much of leverage. Even if they take leverage, it should be capable of paying back in the next 2-3 year time period. The other company where you can illustrate this is VMart. The VMart is a company where for people who have been in Tamil Nadu, they know something like a Saravana store. VMart is like that in the northern part of the country. Very large opportunity. The existing business is 20% ROE business. They have grown their stores multifold in the last 3-4 years. And they've done all this without taking debt in the book in a big way. There is a reasonable debt, but even that can go down now. And they have been able to reinvest back the entire cash flow that they generated into adding new stores. So this company I see as a 15% store growth coming from store addition, and another say 2-3% coming from their existing stores. So clearly 18-20% sort of a growth story for many years to come, because opportunity is their stores attract a lower middle class population, and these people have been there is a clear indication that they want a very good ambience to go and do their shopping, and that's a very clear opportunity that is there, which is being missed out by large players. And VMart is clearly creating a niche out of it and expanding really fast. So that's another story that we can kind of give you. So we are looking for companies who have a very clear capex plan, either through store addition for a retail company, or companies who are capable of identifying new growth opportunities for their capabilities like Navin Fluorine or even PA industry, and then reinvest their higher ROIC in their business right now back into the business and keep growing, keeping this momentum for the next, say, 4-5 year time period. These are the companies that we are referring to as efficient capital allocators, and therefore Capex Maestros. That's the kind of companies that we are.
Great. Thanks, Madan. Next question to you is on digital. With a lot of talk surrounding new digital companies and them gaining market share from traditional players, why do you continue to bet on traditional players?
So the point to be noted here is the Indian opportunity or the context is very different we see from other markets. We have very good private sector entrepreneurs here. These guys have already created very sound business models in the offline channel itself. We are here referring to, say, for example, let's take an ICICI Bank. ICICI Bank has a very strong presence in the liability CASA space, right? And their cost of funding is among the best in the industry. So these guys have already established a very strong business in their offline channel, and they make very high amount of profitability compared to their immediate peers. It can be an ICICI Bank, it can be an HDFC Bank, it can be an Kotak Bank. The ROA of these companies are much superior than the ROA of many other competition. You take any of the small finance banks, except certain rare companies like AU, they don't even touch a 1% ROA. So these companies will not be able to do the kind of digital spending that ICICI Bank or HDFC Bank or an Axis Bank is doing today, to kind of move into a very different trajectory in terms of growth. Let me explain what they are doing. Like ICICI Bank. ICICI Bank is spending almost 8% of their cost into digital spending, which is almost like 4% of the income. On an absolute basis, this is so much of money that not many of the small finance banks or NBFCs will be able to do that kind of spending. So ICICI Bank or HDFC Bank will be spending so much money and creating the digital opportunity, which can enable them to acquire customers, new set of customers, cross-sell to their existing customers much more easy than what they were doing in the past, and overall increase the productivity for the existing branch operations. And now this will lead to cost reduction or more productivity, which can enable an higher ROA further, which they will again reinvest back into the business to keep gaining market share. with their digital capabilities. So the digital capabilities that these guys can bring is in no way will be lesser, in my opinion, than than a digital company per se. And on top of it, their traditional business, which is very highly profitable, is enabling them to create a more profitable and good business case than even pure fintech companies, in my opinion. See, today when we are referring to fintech companies, let's take an example of Paytm. Paytm's model is that I will acquire new companies or new customers through my payment channel. This payment in India is a commoditized business with the UPI. So you don't make money, you lose a lot of money by adding new customers on your payment channel. So in my opinion, that is going to put them in a severe financial stress, and they will need a lot of capital to really start doing the lending business on top of this payment business. Now, when it comes to lending business, they are purely lending it based on velocity, right? That goes through a period of seasoning. So they will go through a very high period of credit cost. A lot of numbers that are floating now for these companies post-COVID world are very very sort of disturbing, to say a very high amount of number. Their capital can get finished off in no time. So I think in that context, if you look at an ICICI Bank or an HDFC Bank, who already have a well-established business and leveraging upon this new digital journey, can really pose a great challenge to the fintech companies also. See, more so, they don't need to, they can get a lot more share out of their existing competition like PSU banks or NBFCs because of this digital journey. So they, even if they don't lose that market share, there is a long way to go in terms of growth, given the growth opportunity that are coming up in India. So not just fintechs, even refer to companies in the consumer space like a Titan. See, Titan, the jewelry is a inventory turnover business. You keep jewelry, like even a Bata, you keep a lot of SKUs in each of the stores, right? It is a highly capital consuming sort of activity. So if you use digital to identify the fast moving items and segregate it, say region wise or store wise, and rationalize these SKUs, you will bring down the inventory level significantly. That is reducing your capital requirement for further expansion. That will lead to higher ROC. Either you can retain the higher ROC and give more returns to the shareholders, or you can reinvest that margin, higher margin, back into the business by adding new stores. That's what Titan is doing. Titan is expanding like never so ever, and they've added almost in my opinion 40 stores last year, I think. So that's a kind of a 15% growth on their existing base. It will further grow as we go for the next 3-4 years. So those are the kind of companies we like, who have very good ROIC. Titan's ROIC is above 25% compared to, say, a competition which run in 10% ROIC business. So Titan can really spend more money and get the digital journey right than what, say, competition can do. And I don't think digital is a great a threat for consumer-facing companies. It was a temporary threat due to COVID, but I think in consumers, particularly in retail, and particularly on the fashion and apparel side, they will go back to the offline stores. So they are in much better position. They can gain more market share out of the traditional offline competition. So these are the kind of companies we are referring to when we refer to the Phygital Blue-chips. These are very strong companies with very strong moat, investing into digital to strengthen their moat further to gain market share or improve their ROC in their existing business. Yeah.
On your favorite theme, Madan, consumption. Consumption's been among your top picks for quite some time, but it's seen multiple challenges over the last 2 years. How do you see value generation here?
Yeah, very good question. I think COVID has kind of created more opportunity, in my opinion, to for investors to get into some of these good consumption companies, stay invested over next, say, 4-5 years to make money. Because what people thought is a lot of the behavioral change which came through due to the lockdown situation, people are extrapolating, assuming that people will continue to do the same thing over in the coming period as the threat of COVID also erodes. I have a very different opinion on this. I feel a lot of this consumer behavior is going to come back to the offline channel. There will be a little bit of that mix change towards online, which will continue, but this kind of extrapolation that is being done for the kind of growth opportunities that are being shown by the online players, I think a lot of it has to be rationalized. The offline players are not here to lose so much of market share to the online players, in my opinion, because consumer behaviors do not. It is a forced restriction, right? A lot of it will change as the threat of COVID. It is already visible. You see a very nice thing happening in the last quarter. PVR saw an increase in the footfall, and Netflix saw a decline in the new subscription addition globally, as well as in India. They have come out with a new package, so they are seeing some growth, but globally they have seen a fall in the new subscription addition. So the kind of box office collection that some of these movies got released in the last 3-4 months are very encouraging, which goes against the theme that is running right now, that the OTT players will keep gaining market share at the expense of cinemas. No, I think cinemas will continue to be the first sort of sought after entertainment for a larger population, and even for the industry also, cinemas will throw more ROC for each money they spend than the OTT platforms. So the cinema, the value chain, the suppliers in the cinema industry, all are waiting for the cinemas to come back, in my opinion. So those will not change dramatically, is my opinion. So these businesses have not done well in a COVID period, and therefore valuations are still very attractive. So you can look into some of these opportunities. One, second is, as I highlighted to you in the initial remark, the growth in the India Inc. salary, best in the last 20 years, it looks like. Just see this graph, 18%, 19% growth in 2021. This is the BSE 500 salary increase, employee cost increase. So post-COVID world, where we saw some disruption in the job creation, we are now in a period, as I highlighted to you, due to IT sector as well as the manufacturing sector looking up very strong. Job creation in the services sector is very strong, as well as in some of the top companies in India. So this is leading to first employee cost increase, and now even the job creation is also increasing. Job creation is increasing, income levels is increasing in the. It is clearly happening in the urban center. Rural is still a little weak, but it will come back next year, is what we feel, because the base has been really strong on the rural front. But otherwise, if you take a 2-year view, both rural as well as the urban wage inflation has been reasonably better, or even much higher than the pre-COVID level. You have to see the salary increase in 2017-18, it was in single digit. So compared to it, we're in very good position right now. Just related to the affordability perspective, today, because of lower interest rates and higher tenor loans, the EMI as a percentage of the income or savings is at a multi-decadal best. We refer to it as an affordability index, and we have shown it here for home loan payments. You can relate it to any product. You can relate it to a discretionary spending. You can relate it to a consumer buying. Particularly, it is so attractive for small ticket consumer spending, like an apparel buying, like an shopping for, say, electronic items, watches, going for movies, going for dine-outs, going for traveling. All these are at a multi-year best affordability for the urban consumers. So we are sort of expecting a very big jump in the urban consumption spending, which is enabled by the salary increase, job increase, as well as given the lower interest rate scenario that we are right now compared to where we are, say, 4 or 5 years back. So clearly setting a stage, in our opinion, for a very strong growth in urban consumption spending, discretionary spending. And I think particularly companies who have a very good pricing power, given the high inflation, a lot of companies have taken 10 to 15% increase in prices. Now, if they can hold on to it in a falling inflation scenario and reap the benefits of growth that I'm highlighting too, then their earnings can expand much superior than what the street is expecting at this point of time. So these are the kind of companies that we are referring to. So the consumption story, I am referring to the discretionary consumption story. looks much better than ever in the last 3-4 years for India investor opportunity perspective.
On exports, India sees a promising outlook for the export of goods and services. Which are the segments firing it, and what are your picks within it?
So I have addressed this as a part of the initial remark, as well as also part of the other themes also. This will have some bit of an overlap with other themes as well. So we find that in a post-COVID world, the opportunity basket for India export story is now much better than what it was in a pre-COVID world, because if you look at two major areas of exports for India, one is IT services. The IT services will touch almost $200 billion. The IT companies which were growing in single digit are now growing in high teens right now. Given the kind of tech spending that global player MNCs are doing, we think this is definitely another 2 years of opportunity. Even the company's commentary is also very similar. So we are still seeing deal flow happening, smaller deals probably, but IT sector is clearly looking at next say 2-3 years of high teen sort of a growth coming through. Certain niche players can grow even above 20%. So that's a very exciting area. Valuations have gone up. We are seeing valuations have expanded at least say 10 to 15% compared to where these companies were in a pre-COVID world. In some of the mid and small caps, it has expanded much more. But let me tell you, the growth number itself has got upgraded significantly, right? Where they were growing in 7 to 8%. Today, they're talking about 15% plus sort of a growth. So a lot of the valuation expansion is very much justified unless the growth goes back to the pre-COVID level. Yeah, there are certain companies which are trading at a very high level where we have exited or reduced our exposure. But we continue to be very, very confident about next 2 years of this earnings growth momentum continuing in IT sector. And therefore, at every correction, you will see us adding new ideas or increasing our weights in existing ideas in the IT space. When we speak to companies in the last con call, they are sounding very positive. The deal numbers have increased, the sizes have come down, but the deal flow is becoming short cycle, and therefore you are seeing growth continue, particularly in all aspects of digital spending. It can be in retail, it can be in travel companies, it can be in say BFSI space. So all the areas across geographies, we are seeing companies getting into this digital journey. Which I covered a portion of it for consumer companies also. So I think IT is a very important pillar for playing some of this export Voyagers theme. Indian IT companies have been very good ROCE generating businesses. So we feel very comfortable there. The second opportunity is also some bit of it was playing for the last, say, 3 years or so, but now the number of companies is increasing. So chemicals have been doing well because globally, China has become a very dominant supplier of chemical, pharma drugs and all, right? The global MNCs have started facing a lot more dominant positioning of China. And therefore, they want to kind of outsource a little bit more towards another country. And India is clearly playing a story there. So, or China itself is cutting down on a lot of their polluting industries, and particularly those polluting plants, which have been established without meeting certain environmental guidelines. And just to gain market share by using old technologies. So again, this is creating opportunity for Indian companies, and therefore the existing plants are seeing higher capacity utilizations, or these guys are getting into adding new capacities also. Like I highlighted for Navin Fluorine, same thing happening for a Chemplast Sanmar. PVC sector has not been seeing a great ROC in the capacity they added. But now, due to China cutting down on the PVC, because they have to cut down because they use old technology. So they are not able to add new capacities using their existing technology. They have to come in with a new technology, as well as refrigerant companies. China has stopped adding refrigerants, particularly R32, these kind of refrigerants. Here, Indian companies have a little bit more leeway because they use best technologies in this space. So now they are able to grow with a very good ROCE by reinvesting money into these areas where they've already been present, and that is creating new opportunities. So these are very specific niche opportunities. We should be very careful about not getting overboard on this and investing into any company here. So we need to be careful about two things: how long this growth can sustain, and what is the kind of ROC these projects are throwing back. So we find in that way some of these chemical companies, pharma API companies, some of these consumer durable companies, IT companies inclusive, are capable of growing for the next, say, clearly, say 3-4 years, making use of this opportunity that is created either by global companies looking for an outsourcing partner in India, or by China itself cutting down some portion of their capacity due to environmental concerns. And these two are clearly enabling India's case. On top of it, just want to highlight one. Many people ask me how competitive is in India in manufacturing. So we like to show your KPMG report, where they have ranked various countries based on primary cost of doing business, which is about labor cost, real estate cost, utility cost like electricity cost and all, and then tax rates, and then interest rate. If you look at the labor cost, real estate cost, and utility cost, India ranks the best among the countries mentioned here. These are some of the countries where we compete a lot. So India and Mexico are on the top league, and where we slightly fall behind is the corporate tax rate and interest rate. With the corporate tax rate, say, reforms that the government has done 2 years back on cutting down on the tax rates for newer facilities, newer manufacturing facilities, and interest rates being lower in a post-COVID world, I think even these areas are getting addressed. So India is already a very competitive country when it comes to manufacturing, and if we can keep our inflation intact, we can continue to become very attractive from an interest rate perspective going forward also. So these are areas. I need not mention the PLA incentive schemes that the government is running. We see certain sectors really benefiting out of it. We can find some opportunities there. But I think purely from an export opportunity, we find India becoming very competitive on the manufacturing space going forward. And you will see a lot more market share being gained by some of these very well-run private sector companies who are kind of going and identifying these opportunities globally, and kind of growing faster than their peers in the Indian context. So these are the companies we refer to as the export voyagers, who are able to establish a very good business case, profitable business case, by looking and exploring the newer opportunities created in a post-COVID world. So this is what we wanted. These are the companies we are referring to when we refer to export voyages.
Thank you for joining us, Madan, and for sharing your insights. It's been quite informational.